Residential sales comparison and income approaches, page 78. Adjustments for financing concessions. Adjustments for financing concessions, which most commonly are financing related costs being paid by the seller, should reflect the amount over and above what is typically paid by sellers in a particular market. There may be many markets in which it is not common for the seller to contribute to the purchaser's financing related costs. If this is the case, the entire amount being paid by the seller would be deducted from the sale price of the comparable. For example, a seller is paying 3 discount points in a transaction in which the purchaser is acquiring a $100 mortgage or $100,000 mortgage. The price of the property is $115,000. Each discount point is equal to 1% of the mortgage amount. So, in this example, the financing concession would be 3% of the $100,000 mortgage amount, or $3,000. Here's the formula. $115,000 sale price minus $3,000 financing concession equals $112,000 adjusted sale price. If it were found, however, that for this particular market, sellers usually pay 1 discount point as normal practice, the adjustment would be only $2,000, 2 discount points. And the sale price of the comparable, adjusted for cash equivalency, would be $113,000. Depending on the particular market, the necessity of making adjustments for financing concessions may not be all that uncommon. Appraisers must be certain that any adjustment truly reflects typical market actions. 3. Conditions of sale. In the previous discussion of the financing term elements, we cautioned that for most residential transactions, comparable data in which the transaction included special financing terms should be discarded. The reasoning for this is not particularly because an appropriate adjustment cannot be identified, but for the most part, because an appropriate adjustment for some aspects of the element would sometimes require a more complex analysis. Therefore, if sufficient relevant data is available that did not include special financing circumstances, this data may prove better as an apples to apples comparison that would not require an adjustment. The advice for the element of conditions of sale in most cases is the same, except for a slightly different reason. Many atypical conditions of sale, especially in residential transactions, are based on actions of emotion, lack of knowledge, state of mind, or pressure-charged conditions such as duress or haste. The problem with these issues in a comparable transaction is not that it is a complex procedure to identify an adjustment, as in financing terms. Rather, it is often not, page 79, possible to associate a dollar amount with what a market participant felt or was thinking during that transaction. Personal interviews with transaction participants may prove to be insightful, but often the motivations and awareness of the participants cannot be aligned with a conclusive dollar adjustment. Such information may be helpful for qualitative analysis. For example, both buyer and seller agree that the sale price of the transaction represented less than or more than market value. This might indicate whether the adjustment would be upward or downward, but likely little more than that. The appraiser could bracket the market value conclusion somewhere above or below what the comparable transaction sold for based on information gained from the transaction participants. But this practice will often not be acceptable in many residential appraisal assignments due to assignment conditions. Considering the method by which the comparable property was offered and sold is also important. Appraisers will most often not use comparable data that's sold via a sheriff's sale, or for that matter, by any type of auction. While selling property by auction is a popular and in some markets for some properties very effective method of generating a real estate transaction, it can often be problematic for the appraiser's analysis. The emotions, motivations, and influences surrounding the transaction, and if the transaction represented a typical market reaction, are difficult to interpret. Usually, the residential appraiser will be able to locate enough arm's length data in a market value assignment that will likely eliminate the need to use comparable data in which there have been atypical conditions of sale. Therefore, if arm's length comparable sales are available to use, the appraiser should probably discard other comparable sales if they sold with one or more of the following conditions. Parties in the transaction were related. Could include family members, landlord to tenant, employer to employee, etc. Personal property was included in this sale. One or both parties were atypically motivated. Parties were not knowledgeable of market, property value, etc. Property sold via a non-conventional marketing method. There are, however, some sale conditions that can be addressed with a quantitative adjustment. They could present themselves as a concession not related to financing and might include repair allowances, decorating allowances, allowances for moving expenses, etc., often as specific dollar amounts if the particular concession. End of page right there. When there is sufficient comparable data available for arm's length transactions for the appraiser to use, data in which there are atypical sale conditions probably should not be used.